Welcome back to the live streams, everyone. Welcome back. I know it's only been, since last week on Thursday, but welcome back regardless. Hopefully everyone has been, doing good so far. I feel like it's been a bit of a slow week, but the markets have been ripping up higher. But we've been focused on individual names, so we're going to continue to do that as long as that trend holds. So today I want to do something a little bit more different, rather than just going through what we're trading or what we're looking at. I kind of want to look over some longer term investments. So as you guys can clearly see from the description box below, we're going to talk about some names that I think will do very, very well for the next few years, maybe even the next few or next decade, right? So let's say from now, this year, 2023, and to the next decade, that's going to be 2033, right? The next 10 years. So I kind of have my, my range, my time range all the way out into 2033. So around 10 years, a decade. So let's go over those right now first, and then I can take you guys' any chart requests or questions as usual. All right. Hey, Do Nothing, what's up? Let's go. Yes, let's go. Hey, Val, what's up? Tuning in from the office. Awesome. I'm glad that you're watching. So the first name that I want to go over is Twilio. So Twilio, we're actually in this one right now currently. I might have to roll up into new contracts tomorrow, depending on how it acts. But first of all, Twilio, if we take a look at the monthly time frame, right? So this one had an amazing run. It actually benefited from COVID, right? It's one of those software names, a communication stock, that's completely online and it's all about software, right? And so software really didn't have anything to do with COVID, right? And communication was very, very important, right? For businesses that were closed or people couldn't go into the offices directly. And so Twilio had an absolutely amazing run thanks to that premise. But once things actually cooled off and we came back down to reality, this happened. Right, I even drew a trend line here back in mid-2021 saying that, it looks like Twilio is about to come back down because we're starting to see lower highs, lower lows, and some very, very large price volatility. Okay, and now, thanks to this large move to the downside, okay, Twilio is now sitting back to 2017 and 2018 levels, plus right where they IPO'd as well. And so it hasn't reached the all-time lows here, and I don't think it will. But as long as Twilio, the company, continues to do well, this one is an essential company. I think it's going to be a leader in its space, right? If not, it already is, right? And Twilio, in my opinion, they have a lot more work to do. They need to make sure that they have a sustained stable revenue growth, which is very, very important for a very unprofitable tech company, or especially a software company. And so, Twilio, I believe, let me see. I believe they're still unprofitable, and they're not expected to be in profit in like the next 2 to 3 years. But either way, yeah, so they are definitely unprofitable. And, it's something that I think, especially after this rapid growth in share price, right, where Twilio stock was completely in a different reality, and the fact that we come back down to reality, we come back down to earth in our same dimension here. We're going to start to see a little bit of a slower, more, reasonable and logical growth in the long-term future. So Twilio is one of those first few names that I think you guys should be looking into for long-term I guess, position for the next 10 years. And I think, this one, Twilio, as long as the company continues to work on its fundamentals, its revenue growth, its earnings growth, and just trying to get back to break even, because they do have a lot of debt. I believe they have what? How much debt did they have? Let's see. Yeah, so they have a long-term debt of 1 billion. That's huge, right? And they also had a net loss of 482 million on the backdrop of 983 million of revenue, right? And that was just the third quarter of 2022, okay? And so nothing has really changed much from that third quarter of 2022. We've been pretty stable in how much they've been earning, and and how much their revenue is as well. But again, even though their revenue might have grown just slightly from the previous quarterly earnings reports, they're not making a lot more, right? And so right now, the company is focused now on the longer term, on figuring out how they can be, how much they can actually take home with them from that revenue. And I think Twilio can become a very essential service for a lot of businesses as a communications software name. And there's a lot of different unprofitable tech companies out there, and Twilio is one of many. So you can have a lot of people disagree with me, you can have a lot of people agreeing with me, right? There's going to be both groups on saying whether or not Twilio is going to be a great long-term investment or a very bad long-term investment, right? And no one really knows, right? Because the company is the one that's managing the company, right? It's managing itself. And I'm not a part of the company. I'm not part of the board of directors. I'm not the CEO, right? We're just here as long-term investors. So, I don't really care if anyone tells me that it's a bad investment. I don't really care if someone tells me it's a great investment and I should put all my money into this company. I'm just gonna do what I do normally, do the research, right? Do my due diligence and see what I can do with my money. Okay, so that's kind of my disclaimer here, I guess, for my long-term picks, right? Don't give in to, people being ultra bearish or ultra bullish on any single name, especially on unprofitable tech growth stocks, right? And so just take everything that I say right now at face value. That is the most important thing for you guys right now whenever I talk about a long-term investment in an unprofitable growth tech stock. All right? Now, technically though, right, on the technical chart, you guys can take me a little bit more seriously here, right? Because we have observable evidence of how the price is moving. And so on the weekly time frame, right, this is a name that I sent in to my private CFO members on Sunday night. We have a very, very textbook bull flag forming on the weekly. I mean, this is really textbook. We have our flagpole here. If you guys can't see it, let me draw it out for you. Right, very, very simple, just like coloring class when we were in grade school. Right, and then we have our flag. Or if you guys want to keep it simple, a flat top and a flat bottom for a very, very textbook, classic bull flag. Right, it looks like a clear flag to you guys, right? And so we have our major level of resistance at $69 and a major level of support at $61, or specifically 61.20. And so this obviously is a very inherently bullish chart pattern, obviously, right? Hence its name, bull flag. But I want you guys to notice one thing. On the weekly time frame, we have finally an official cross over the 10 and the 21, right? This is what we call a bullish crossover, when the 10 SMA crosses over and up over the weekly 21 SMA, or just on any time frame, right? And the opposite is when we have a bearish crossover, when the 10 SMA crosses below the 21. And if you guys have been with me for a long time, you guys should understand that when a short-term SMA crosses up a longer-term SMA, okay, that's very, very bullish. It's a bullish indication. And that's why we call it a bullish crossover. And in the opposite side, on the other hand, when a short-term SMA crosses below a longer-term SMA, that is called a bearish crossover. And you need to take those indications seriously, right? Because SMAs tend to provide some very, very good results. And so we're at the cusp of a potential breakout from a bull flag coupled with a bullish crossover of the 10 and 21. And for the fact that we've been consolidating over, okay, now we're talking about the longer term perspective here. We've been consolidating over the weekly 50 SMA, this dark blue line here, tells me that the sentiment is changing in the stock, right? It seems like we're starting to see some seller exhaustion. It makes sense, right? We've hit a high of $457.30. That's very far away from today's close price at $65.53, right? And so there's definitely some sort of a seller exhaustion going on because on the short term, we're bullish, plus we're backed by a longer term bullish perspective by staying and consolidating up above the weekly 50 SMA. Okay? So technically, I want to be very, very bullish on this one. All right? Let's just throw out fundamentals for now and just focus on the technicals. And technically, right, we have a very bullish chart pattern. And if you guys want to kind of go out even further and get a bigger picture, we have what we call a double bottom chart pattern. The left bottom is here and the right bottom is over here. And the, I guess, quote unquote neckline resistance for this double bottom is at $80. And so for the fact that we've been able to reach $80 while we were, okay, again, while we were forming, and we're still currently forming, okay, this double bottom chart pattern, there's a chance that we can possibly hit $80 again, because we did that in previous times and previous areas. And so again, you know, whenever I am going over a stock, guys, take them at face value. But when we're talking about technicals, right, you might want to take me a little bit more seriously, right? And so, you know, after 7+ years of doing technicals and, you know, giving out trade ideas based on technicals, I've become very accustomed to how I am able to look at stocks, predict how stocks can move, and predict where prices can move to from where they're from, right? So, you know, Twilio, I think in the longer term can definitely reach $80. But now it all depends on how individual, you know, software stocks will move, like Twilio, on the broader base of the fact that the market is overextended right now, right? And so with that with that general foundational knowledge that the market is, you know, potentially very overextended right now, which it is. If you take a look at the RSI for SPY as well, and QQQs, we're really starting to hit that overextension levels. And there's a possibility that we can see a very huge snap back to the downside, which can affect tech stocks like Twilio. Why? Because tech has been leading for quite some time, right? Tech has been leading this entire market run up into this new bull market that we are currently in for 2023. And if you guys haven't watched any of my videos in the past, including last year, or if you don't follow me on any socials, I have been saying that the market will turn into a bull market in 2023, and we're going to be seeing some great returns all the way up into 2026. I have been saying this since last year and early this year as well. If you guys are wondering when I was saying that, well, October lows and December lows. I have gotten a lot of shit over saying that, you know, the market won't crash during October lows and December lows because there really was no reason. I didn't see any observable data that was telling us that the market was going to crash. And look at where we are at now. Bears are still saying that this is a bear market rally. How can it be a bear market rally when this is a huge bull market run? Right, this is a bull market run. We're literally near all-time highs once more that we hit back in early 2022, right at the start of 2022. All right. So again, we are not in a bear market rally. This is different. All right. It's all completely different from what you see here, 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 and I can go on and on and on again. Okay. I mean, literally, there is nothing to tell us that we are in a bear market rally. And apologies about all my lines here. Again, TradingView tends to coincide all my major levels from every single time frame whenever I am at the weekly or the monthly, which is why it looks very, very clustered with levels. Okay, so now let's go back to Twilio. Okay, so again, in this one, I'm definitely looking at for a longer term perspective. I might even be getting leaps very, very soon, possibly strikes around 100 or 110 in between those ranges. Okay, as far out as possible. Okay, but first of all, I had to see if there's going to be some sort of a break to the upside. All right. Okay, so the next one is CVS. Yes. You guys know that I'm long in this one. I have been saying this since back in March. Okay, the lows of March. All right, and I believe I got my first position, equity and leaps as well, in March, if I'm not mistaken. Yeah, around March. And I continued to dollar cost average every single time we had a nice bounce from a support level. And right now, thanks to my dollar cost averaging, both on equity and leaps, I am up on both of them. Okay, so I believe my leaps position, right? My leaps position is up 25%. Right? And I'm just holding 3 contracts. Right? I might add a little more depending on if CVS decides to dip a little bit more in the near-term future. Who knows? Right? Because again, we haven't made higher highs yet. We're just having a little tiny base that we've been forming so far. Right? We haven't made any attempts to have a higher high. Right? So far, all we've been doing is going down. Lower highs and lower lows. Okay? So CVS, right? I just had 3 contracts on my leaps, but I am up 25%. I broke even like maybe a week and a half ago. Okay. And so thanks to my DCA and on my equity, right, I am now in profit for both of my positions on equity and leaps. And so CVS, I've been talking about this for a long time. All right, so if you guys haven't been catching up with me, like I said earlier, on YouTube, on my live streams, on social media, you guys know that you guys should know right now, right? This is your opportunity. I'm telling you guys right now, CVS is at a great discount. I'm about to get another dividend. I believe what is it? Next week or next week? I already received one, and so this dividend check is going to be a lot bigger than the previous one because I've been dollar cost averaging into CVS. So this one will be very, very nice. But overall, again, CVS, great discount, right? They've increased their dividends as well. Okay. Now, there is a slight upside risk that I've been currently thinking about because, again, you know, what I said earlier in the live stream, take my fundamental advice on, or fundamental, not even advice, fundamental thoughts and opinions on our long-term names here. Right? Because again, I'm more of a technical trader. But CVS fundamental wise checks out. Right? It looks really, really good. But one thing, there's just one thing that I know can potentially hurt my shares and my leaps. Okay, so CVS might be seeing a lessened economic moat as they have been closing stores, right? And they're closing stores for a good reason, but it all depends on how they execute in the next couple of years, next 5 to 10 years. Because I believe CVS will continue to operate and still be in business in the next 5 to 10 years. Right? It's a very basic necessity, right? It's a basic necessity business model, right? And you know, even myself, I visit CVS a lot, right? I visit CVS quite a lot, and every single time I go to CVS, there are a lot of people there, right? And so, you know, as long as CVS just continues to keep up with the changing times, the modern times, I think CVS will continue to do well. But again, if they fail, right, that's the upside risk that I'm keeping in mind for the long-term future. If they fail to manage their finances, right, their financial future, excuse me, and if they don't execute well, right, this one might be a fail in the next few years. So CVS, continue to watch this one. If you guys aren't in yet, maybe put in a few shares, right, 5 shares minimum, okay, at least, and see how this works out. Okay. All right, so the next one I have is HSY, Hershey's. That's right. We're talking about this great chocolate company. I mean, if you guys don't know what Hershey's are, I mean, come on now. All right. So, this one, I was looking at this one actually back in late 2020 and into early 2021, and this one absolutely exploded. All right. So, thanks to COVID, we saw a retest on the weekly 200 SMA, right? I mean, we've been dying for one ever since that first retest back in 2018, right? And so, I think for Hershey's here, there's a good chance that we can continue to grind up higher, even if we have strayed quite far away from the 200 SMA on the weekly time frame. And whenever we see this huge divergence, this huge distance from the 200 SMA on the weekly time frame, it kind of scares me. But this one has been on a tear, right? And for the fact that we have now come back down to hit the weekly 50 SMA, which we have been retesting multiple times for the past 2 years, okay? There is a chance that we can start a potential long-term entry point on HSY. And guess what? This name also pays a pretty good dividend of $1.03 or $1.04, right, per share. It makes sense, right? If you guys haven't noticed yet, the companies that have more expensive share prices, because again, they've had such great growth over the past few decades, they have bigger dividend payouts, obviously, right? But there's also other companies that provide some very decent dividend payouts for how cheap their shares are, and we're going to talk about some of them. Okay, if you guys have seen my tweet about my live stream tonight, I'm going to talk about Verizon and T. Do you guys remember what T is? AT&T. So if you guys aren't located in the US, Verizon and AT&T are probably one of the biggest, or they are the biggest, two competitors obviously between each other, but they're the two biggest mobile phone carriers, right? And they provide all the data for mobile phones. So Verizon and team AT&T, we'll go over them, but those are the names that provide some very, very good dividend payouts with how many shares that you can actually get. Because again, HSY is not really realistic for a lot of people who are just getting into long-term investing, especially if they want a nice dividend every single quarter. Because again, it's a very expensive stock, and you need to pay $239.84 on today's close price in order to get one dividend payout of $1.04, right? If I'm just rounding up. And also, again, Hershey's has been increasing their dividend over the past 2 years, just like CVS. And I'm taking note into a lot of companies that have started this trend of increasing their quarterly dividend payouts for the last 2 or 3 years. And Hershey is one of them. And so with the fact that Hershey has been absolutely decimated from all-time highs at 275.81 back in mid to early May, okay, the fact that we have come back down to the weekly 50 SMA here tells me that there can be a potential starter position for HSY. And again, I'm just bullish on this because, I mean, who wouldn't be, right? Everyone loves chocolate unless there's a few population of humans that hates it, right? And I believe Hershey's was able to see a huge growth in their share prices because of the fact that there was going to be, or I think there was, I believe there was somewhere around early 2021, I believe, a chocolate shortage. I don't know if I'm mistaking that with coffee, because I definitely know there was a coffee shortage, coffee beans, which kind of made coffee prices go higher and rocket higher, especially the coffee beans. But now I believe they're back down to quote unquote regular prices, even though I haven't really seen that yet. But the market seems to be telling me so. But Hershey's, definitely, I believe chocolate, if I'm not mistaken. You guys can correct me later on in the comments down below. But yeah, so I do believe, in my really shaky memory from 2 years ago, that chocolate has some sort of a supply shortage or issue, and obviously production issue as well. So whatever the case, from 2 years ago, okay, I am going to be bullish on chocolate, right, for the long term. And guess what? Chocolate has been moving up like crazy since the 1960s. 1968, right, specifically. So, I wouldn't be so, I guess, ignorant about where Hershey's going to go next, right? And so Hershey's has been doing absolutely amazing, with this incredible growth. It looks kind of like a Monster, right? Monster energy drink, right, on the monthly time frame. Right, I mean, look at this, right? From penny stock all the way up to the hundreds. Well, Monster was in the hundreds, but they had a stock split. So I believe it was a 2-for-1 stock split. So again, okay, so let's get back to Hershey's here. So this one, I think we're at a very good technical area, right, for a potential starter entry. And again, longer term investments are intended to be dollar cost averaged. But here is where that problem comes in, where there is a risk into dollar cost averaging. So for now, Hershey's, before I get into that topic, Hershey's looks pretty good. Right, it's sitting around, and it's made a support around 237.50 to 238. That's a good kind of range to be looking at for support on the daily time frame. And if you take a look in the past here, the previous data points that we are right now forming some sort of a range between 237.50 and 240.50. How do we know this? Because in the past, again, there's a previous area or level or levels of resistances. Okay, and so if we decide to continue to hold 237.50 or 238, I believe we can get a nice long-term entry, right? At least for a starter position. Right? I don't want you guys to be buying 10 shares straight out, or 20 shares. Okay, start out with 5, 3, right? Just start out slow, okay? Because again, we have really just divulged so far away from the weekly 200 SMA, which we haven't retested since the major 2020 market crash dip, right? So we don't even have to come back down to the weekly 200 SMA. But again, after hitting all-time highs and then rejecting like this in a very, very bad bearish manner with increased bearish volume, just makes me a little bit uneasy, right, at these current prices. So that's the reason why I think there's a possibility that maybe, just maybe, we can come back down to the weekly 200 SMA, maybe in the long-term future. Who knows? Maybe we come back down to the level of 200, or kind of in an area like we saw right here, okay, as you see on the weekly time frame, okay, maybe around a range of 198 to 200 might be a great area to be looking at for a longer-term entry point. Right? Maybe you guys can wait, right? But if you guys want to get into action, right, who knows? We might actually hold the weekly 50 SMA. You guys can get in now and ride the wave up higher into new all-time highs once more. Okay, but again, those are my two probabilities here, right? This range here is where we can potentially get a starter entry point for HSY, or you guys can decide to wait and wait and wait until potentially there is a possibility that we can come back down and retest the major level of, major whole number level of $200, or somewhere around between the levels of 198 and that $200 significant whole number level. And if that does happen, if we do come back down there, I expect the weekly 200 SMA to be resting around this area for that first retest ever since the last previous retest that we got nearly 3 years ago. Okay, or it's actually, yeah, nearly 3 years ago, right? So, you know, or it has been 3 years. My apologies, guys. All these numbers that I'm seeing right now on the chart is just screwing my brain over. So that is kind of my outlook on HSY. Right, you guys again can get a starter or feeler position for HSY. But yeah, that's what I think. All right. So let's talk about the really bad stuff about dollar cost averaging. So let's take a look at Verizon. So Verizon is plunging to the ground, right? And I was really just expecting this one to for me to at least be able to get some sort of an entry last week, but I didn't, because it's kept on plunging lower and lower and lower. And this one's making rounds on major stock or major news networks that track the overall economy and the stock market. And so, Verizon here is back to 2015, 2014, and even 2013 levels. And it can still drop lower, maybe even hit 2012 levels, right? And here's a lesson here, right? And this is what I'm trying to say. So Verizon has a pretty good dividend, right? For such a cheap name. 65 cents. It's just like CVS, right? So CVS has a dividend of 60 cents or 61 cents if you guys want to round up. And CVS right now has a share price when it closed today at $72.31. But Verizon is half of that price on CVS, or more than half. Right? It's at $32.27. Right? It's around half. And so the wheel should be turning around in your head, right? The gear should be turning. So Verizon has a pretty good dividend for a relatively pretty cheap name. And so just think about the fact that people who are buying Verizon near the highs here, maybe even the dip in 2020 here, right, at the weekly 200 SMA, great entry point. They kept on buying and buying and buying throughout 2021, 2022, and especially 2022, as we saw a jump in the volume here in 2022, all right? Because people were more focused on value names compared to growth names, right? But again, everything got slaughtered, literally, all right? There weren't a lot of names that were able to beat the market in 2022, except for the entire sector of energy, right? The energy sector completely outperformed in 2022. Obviously, we all should know that by now. So regardless of that, okay, these are the dangers of stocks like this. Cheap names, relatively cheap names that have very high dividend yields, right? And it traps you into the thinking of dollar cost averaging, right? Because all the people who have bought, let's say who just entered into Verizon from 2020 to 2022 and are still holding now, right? Now they're just holding, right? They have accumulated a pretty good position. Their initial investment is down a lot. And in order to be able to break even, they might need to buy even more shares as the stock price continues to go down, while their initial average entry price is most likely still going to be way above the current price that it closed today at $32.27. And again, all right, they're just sinking their money to the ground, even if, right, well, as they're trying to make sure that they get enough of the dividends every single quarter to make it worth it, right? To make it worth that they're actually in this position, balls deep. There's that funny statement for tonight. So But literally though, guys, right? These are the dangers of dollar cost averaging. It can literally trap you. It's called a value trap. You guys can look it up, right? Or dividend trap, right? Value or dividend trap, right? Really both the same thing. So Verizon here is a major example on one of those, things called value traps or dividend traps. So for the people, again, who are still in Verizon since 2020, right, on this dip, you guys got a great entry, right? That's great. But since you guys are playing this as a dividend name, you guys have to buy more and more as the stock continues to go down and down and down, which means your principal value, your principal position's value continues to go lower, even if you've been getting that dividend payment. And guess what? The dividend is not more pricier than the share price. The share price is, right? The share price is a lot more expensive compared to what? 65 cents per share. So you're going to be spending a lot more in order to try to dollar cost average, right? So you're basically digging yourself a hole in order to try to crawl out of that hole that you've made from holding on to a name that continues to give you this value trap, this dividend trap, making you think that, hey, one day I can definitely get all the losses that I've obtained from the fact that I've been holding on to this position and I've been increasing this position, all right, just solely for the fact that I want to make sure that I get these big dividend checks. But it's going to take a long time. Why? Because the dividend payout is a lot smaller compared to the actual price that you need to pay in order to increase your position and in order to dollar cost average, well, your entire entry point, right? Your principal entry point, right? Your dollar cost averaging down on your initial entry point. And so, this is one of the big upside risks to any type of a value name that you want to look for some dividends every single quarter, right? So CVS, same thing for me, right? I can be potentially in a really big value trap, but so far it's working out, right? Because again, I went through the fundamentals and all that good stuff, right? I did my due diligence. I saw that was a very good investment for the longer term. And unless something changes from that, when I do the analysis again, I'll just have to get out, right? But so far, I've got a pretty nice dividend, right? Since March, right over here, okay? And I'm about to get a bigger dividend check now because I've been able to dollar cost average the last couple of months. And I've been telling my private CFO members this every single time. And I also have leaps that are up 25% on the backdrop of my equity position. So, overall, really good so far, really good performance. But again, that dollar cost average trap, that value trap, that dividend trap is still very much present. VC, great example. Okay, another great example is AT&T, right? So AT&T is an even cheaper name, right? And the dividend payout is not bad, right? But it's not the best. But again, look at this. The share price is a lot cheaper compared to, let's say, Verizon. And I'm comparing these two because, again, yes, they are in the same sector, right? Same industry, and there are peers, they're competitors. And so Verizon and T, right? They are both really just sinking to levels that we haven't seen since, well, especially for T here, since 2012, right? And even back in actually we're almost hitting levels we haven't seen in 1999, right? So, Verizon and T is one. Some people ask me, "Hey, Chris, what's up, man? It's been a while." Thank you, bro. But yeah, so people ask me, why do you even focus on the bearish side, right? The bearish perspective, even if so. Andrew, you did all your analysis, your fundamental and technical analysis, and you figured out that you can be biased and you want to be biased to the bull side. What is the point of being bearish, right? So, for example, on CVS, right? Why am I even thinking about the fact that there is that risk of the dollar cost average trap, or value trap, or dividend trap, right? What's the point of me thinking about that? Because you need to be always always assessing your risk, whether it be an investment, a long-term investment, whether it be a swing trade, whether it be a day trade, whether it be a few second scalp, right? A scalp trade. And so even if I'm looking to hold for the next 5 to 10 years on CVS, I know what I need to be looking out for to continue to assess my risks on whether or not I want to increase my position or I just want to hold it and manage it for the next 5 to 10 years. That is the reason why I always want to know exactly what could be going on the other side of my bias. Because newsflash, guys, the stock market is a dichotomy, right? If we are biased on one side or the other, everyone will be winning, right? If everyone was bullish, well, everyone will be winning. If everyone was biased, everyone will be winning. But it's not like that, right? Again, news flash, right? Really big news flash. The market is a dichotomy. That is the reason why I'm always assessing my risks and understanding what could be going on the other side, even if I'm looking for a longer term investment. Okay, so with all of that in mind, right, let's go over our long-term investments today that I just shown you guys. Twilio, okay, ticker symbol TWLO. All my private CFO members got this on Sunday night, and I gave you guys a technical, reasoning and a little bit of the fundamental reasoning as well. The fact that they've now reorientated their goals, their long-term goals for the next 3 to 5 years to focus on revenue growth and profitability, right? So again, these unprofitable tech growth stocks, especially Twilio, this communication stock specifically, is looking to become profitable, right? Because they are very unprofitable right now. And so they're looking to try to maintain a better profit margin and increase their revenue, right? And the revenue growth percentage. So this one, definitely something to look out for. Okay. And then again, we just looked at CVS. So this is our second name, right? And then Hershey's, right? So I've given you guys 3 names that you guys should be considering for your longer term perspectives, right? One is a tech growth stock name and the other 2 are now value stocks. Okay, it's good to have a nice diversified basket of eggs, right? Or I guess diversified eggs in your basket. there are a lot of ways to think about it, right? So either you have different baskets, right? Multiple baskets of a lot of different eggs, or you have one basket that has a lot of different eggs. I don't know. People tend to use either one of those perspectives. Some people like it more on the one single basket with different type of eggs, or the multiple different baskets. I've heard everything for the past 7 years. So, I mean, you guys can fight over that. I don't care. But, I've seen FinTweet, just absolutely tearing each other apart for some really stupid reasons. But you know what? It is what it is. The market is, I think that's the beauty of the market, right? It provides us with that dichotomy of being either being bullish or bearish or being, really intent on, or really, I guess, intending on being right on a certain perspective, let's say. So, I think, again, the market, it just shows that beauty of analysis on being bearish and biased, or at least being bullish biased or bearish biased, and being able to also take a look on the other side and what other people are saying, or what other analysts are saying, or what the numbers are actually telling you, right? So again, hopefully you guys take my long-term investments, these 3 names, at face value, but a little bit more seriously when I'm talking about the technical charts, right? Just like I explained to you guys on Hershey's, right? So again, quick summary. Hershey's, yes, you can start a starter position around here, around 237.50 to 240.50. Right, it's a nice little range that we can potentially find some very good support, because again, we have seen these 2 levels formed in the past, okay, back in 2022, and on the weekly time frame, we have this weekly 50 SMA that we are currently sitting on and resting on. Or the other probable scenario is that we come back down, because we've been seeing a harsh rejection from all-time highs, okay, with increasing selling volume, we can break below the weekly 50 SMA and we can hit the weekly 200 SMA, which should be around $198 to $200. This little next range that I have underneath this major range here, okay? And why am I saying that? Well, ideally, and based on how I know my SMAs move on every single time frame, yes, I know how my SMAs move on every single time frame because I've been using them since I started, right, 7 years ago. So based on my observations and how my SMAs move, the 200 SMA most likely on the weekly time frame will be sitting at around 198 to 200 as it slowly, ever so slowly, continues to climb higher and higher and higher. Okay, and so unless the stock decides to stay up here, right, we might never even see 200 again per share for Hershey's. Right, and that's the reason why I'm giving you guys two different scenarios again. This also applies to the fact that the market is a dichotomy. All right. Okay, so again, we went over Tulio, Hershey's, and CVS. Right, those are my three long-term picks for you guys for tonight. Right, so now let's get into the part of the live stream where I take in your chart requests. Right, so if you guys have any tickers that you guys want me to go over, since I am a really technical expert here, I take that term expert lightly because again, the market is always teaching you lessons every single day. Right, no matter how long you've been observing the markets, no matter how long you've been active in the markets, whether you're observing or acting, active or experiencing or even just analyzing the markets for fun, the market will always be giving you lessons every single day, every single month, every single year. Okay, and that's how you humble yourself, right? I don't care that I've been observing, trading, being active in the market for 7+ years. I know I have a lot more to learn. Okay, I've talked to people who've been in the markets for 20 years, 10 years. That's what they all say. All right, and that's how you stay in the game, focused and humble. All right, now, again, if you guys don't have any tickers that you guys want me to go over, then this will be the end of the live stream. But I will be waiting, around, the next 2 to 3 minutes if you guys have any tickers that you guys want me to go over. So send it in the live chat right now. If you guys don't know where the live chat is, well, I think, it's going to be pretty self-explanatory on where you guys could find the live chat. Hey, Val. Okay, let's go. I recognize that second ticker. IEMG, isn't that the emerging markets? Yes, it is. Yes, it is. Yeah, so I'm glad that you brought up IEMG because again, I know you read it in the newsletter. And so, guys, for all the people who are watching this, who are not private members, and are watching this recording right now, I've been talking about international markets, all right, and emerging markets especially. So IEMG, or you guys can just look at EM, all right. EM is also emerging index fund, right? I mean, they're both kind of acting the same, but EM is a lot more cheaper. Well, relatively speaking, I gotta say the word relative. But so IEMG, technically on the weekly time frame, and again, Val, hey Chris, thank you. I'll go over those as well. So IMG, I want you to look at this one on the weekly time frame. Okay. So Val, I know I said this already in our one-on-one mentorship session, but for this one, if you're looking for a longer term investment, okay, focus on the weekly only. Okay, focus on the weekly only, and focus on the price in the weekly time frame, or even on the monthly, because I've told this to my private members when I talked about CBS the first time back in March. I said I'm only going to take a look at the weekly time frame, right? As often as possible. Maybe I might look at it on the daily sometimes here and there, but I'm gonna focus on the weekly. Why? Because if I want to make sure that I have a mindset of it being a long-term position, then I need to be able to observe it from a long-term perspective, right? It makes sense. You want to make sure your brain is following along with your thoughts. Whatever you're observing, right? Your eyes should be following along with your thoughts. Your brain should be following along with your thoughts as well. So, IEMG, definitely take a look on the weekly time frame. And what do we see here? Well. Okay, we have a resistance level at 51.50. Okay, and also a possible. It's kind of off, but I mean it's relatively there, I would say. Okay. Inverse head and shoulders chart pattern. Okay, it's not really there, right? It's kind of screwed up, right? It's kind of botched, but I mean you can make a case for this, an inverse head and shoulders chart pattern, which is inherently bullish, with a neckline resistance of $51.50. And guess what? On the weekly time frame, we have the 200 SMA lining up perfectly with the neckline resistance of $51.50. So what does that mean, Val? Your entry point should be, a breakout entry point should be at 51.50, or maybe if you just want to round up, $52, right? As long as we hold over 51.50 plus the weekly 200 SMA, as seen right over here, right? Let's make it yellow so we know which SMA we're talking about, okay? And if you want more confirmation, $52 is your best entry point for a longer term perspective, okay? All right. So Val, hopefully you can give me a thumbs up if that makes sense. Just a quick analysis here. Very, very simple technical analysis. And then now let's take a look at your first name. Oops. Whoa. Interesting. Covered call ETF. I think I heard of this one before. Yeah. I've heard this back in, what was it, 2020, I believe. Yeah, it was my first time seeing this one, QYLD. Hey, high five to you too, Val. So this one, well, just by the chart, I don't like how it looked. Excuse me. So first of all, yes, it's liquid because it's over 1 million in volume, in average volume. But I just don't like how the candlesticks look like. However, okay, that's just from my personal opinion, but that shouldn't deter you from the fact that the price has been actually going up, right? I mean, it makes sense, right? This is it looks like it's kind of tracking the Nasdaq here because it is, right? Nasdaq 100 covered call ETF. So, and again, if you guys don't know what a covered call is, I mean, you guys, we have Google, right? So, I mean, if you guys don't know what covered call is at this point, if you guys have been in the markets for a couple of years, maybe it's time for you to know what a covered call is. But just let Google do its thing, search it up. Very, very simple. Yeah, it's the most powerful and most popular search engine in the world. Maybe even ask ChatGPT. But again, covered call is a very simple concept. But do your thing, guys. If you guys don't know, I mean, I would think that you guys should know by now if you guys have been in the markets at least for 2 to 3 years. But yeah, anyways, sorry about the tangent. So QYLD, I mean, if you're going this one solely for the dividends, right? I mean, I would say T is a lot better, even if T looks absolutely horrible, right? Since we've actually broken below the lows of 2022 as well, I would say this one is a lot better, just solely off of the fact that it pays a greater dividend, and it's around it's actually cheaper now, and if you really want to play QYLD, I would suggest other names like AT&T compared to this one. It is in a nice uptrend, but it's also a little bit overextended. But I would say, this one you might have to wait a little bit longer for a little tiny, maybe even a bigger, let's not say tiny, a bigger pullback. All right. But yeah, QYLD, it's all right. It's all right. I mean, it moved. It really didn't move today, right? It ended at 0% today, right? There was no negative return or no positive return. Okay, so yeah, I mean, you don't have to put it in the bin. Well, you can continue to watch it. I just personally don't like how it moves. Okay, just observational point. But again, that shouldn't deter you just because I said I don't like how it looks. Because again, what has the numbers been saying? It's been going up, right? I mean, from the previous biggest recent low in October was 13.70, and we're at $18, right? That's a pretty nice gain. Okay, so again, take that at surface level. Okay, but hopefully that kind of covered your tickers there. So you're welcome. You're welcome. All right, Chris. Hopefully you're still in. So Amazon, yes, this absolute beast. I'm so glad this one was. This one had a nice stock split here. What was it? 10 for 1? Or am I tripping? 20 for 1. I think Google was. Wait, was Google the one that did 10 for 1? No, it was 20 for 1 as well. Huh. Maybe I'm thinking about Shop. I'm going on a big tangent today, guys. Yes, Shopify was the one that was 10 for 1. Man. There's a lot of stock splits that happened last year. Anyways, so Amazon. Let's go to weekly too. Let's take out the my technical analysis here. So Amazon. Okay, so this is where it gets a little bit tricky, right? So the weekly has been suffering from the weekly 200 SMA, right? So this is the big breakout, big potential breakout, right? Obviously, right? Just based on this trend line here that I just draw for you guys, right? And again, all right, don't mind all my levels here. TradingView loves to coincide all my major levels that I've drawn on any time frame onto the bigger time frames too, along with the levels that I've drawn on the bigger time frames too. So if you add those together, you get this crazy mess. So don't think that I'm just drawing levels everywhere, guys. Trust me, it's just TradingView coinciding the levels. You guys will understand if you guys do that. If you guys actually use, right? If you guys actually use TradingView, and you guys are actively doing technical analysis. Anyways, so Amazon, great breakout, but longer term perspective, we are not in an official breakout to the long term, right? To the long side. Why? Because we're still using the 200 SMA on the weekly time frame as a huge crux to any type of upside move to the upside. Like literally, right? Upside moves to the upside. So earnings are coming up, right? Big tech earnings are coming up. Amazon is going to be in the last week of July, so I'm not really worried about it. But again, as long as Amazon starts to move sideways here, right underneath that weekly 200 SMA that we just saw, right? I'm good, right? As long as we start to, again, like we did today, we use 131.50 as a level of new support. Why is it new support? Well, again, I mentioned this multiple times 3 weeks ago, back in late June, that 131.50 was going to be a hefty level of resistance. And if we do break over that, we're going to see an impulsive move to the upside and possibly hit 136. And guess what? That's exactly what we did last week. Right? We hit 136 and we immediately rejected. Why? Because we start to get overextended on the daily and the weekly with that 200 SMA on the weekly time frame. Okay? I mean, I even said this a long time ago too. Let's target at 136. So Amazon, as long as we hold over 131.50, or if we continue to use this as a bounce, as a support level, we can get long here and sell at any intraday level of resistance. All right, very, very simple day trading strategies that you can use using the technical analysis here that I have for Amazon. So 131.50 was used pretty well as a level of new support from a previous old resistance. And so as long as we're able to do that continuously, we can get at least 2 to 3 more days of the same bounce at 131.50 if and only if we come back down to retest 131.50 as new support again, which can happen tomorrow. Okay. Chris, you said LLAP. I'm curious for a longer term position play. Had a friend of mine bring it to my attention. Ooh, interesting. Because I heard this name too. Oh, looks like one of those stocks. Yes, that's what I thought. It's a SPAC. It IPO'd using a SPAC. If you guys don't know what SPAC is, please use Google. Just like with cover calls, it's there for you guys to use. But if you guys don't really understand what SPAC is, or if you guys want to know what it is, just look it up right now, or I'll just tell you guys what it is. The acronym is Special Purpose Acquisition Company. Okay, SPAC, SPAC. It was just another vehicle for people to use, right? Companies to use to IPO, a different way than the traditional way to become public in the stock market. And there's an entire craze to it, and obviously that fizzled out pretty rapidly. But overall, LLAP. So I don't really know what this company does, but based on TradingView here, it's a telecommunications equipment company based on focusing on electronic technology. It looks like okay, yeah, I was just about to say it kind of, well, based on its name, it looks like it's about satellites. Interesting. End-to-end satellite solutions, including spacecraft design, development, launch services, and on-orbit operations. It kind of looks like, it kind of sounds like as well as RKLB. This is another popular name too. This one has been absolutely on a tear, Rocket Lab. Okay, but anyways, so as more attention is brought forward to space exploration, especially just into near Earth orbit, right? I think they call it NEO, if I remember, right? So that acronym NEO, near Earth orbit, is becoming pretty popular too, with companies really trying to operate in near Earth orbit, right? So if LLAP can definitely become a beneficiary of a potential hype of companies, right? Of trying to gain access and broaden their businesses in near Earth orbit, NEO. So if LLAP is able to do that, well, this one can definitely skyrocket, just like Rocket Lab is skyrocketing currently right now, and it's short squeezing too. And right now, again, in a bull market, I haven't seen the financial statements of the company. I'm pretty sure it's not going to be looking good based on how they've been performing so far, stock wise, right? But I love the fact that we've had this nice big rush in volume, in average volume, because the volume was pretty dwindling back then. So I like this new influx in volume. It's become a bit more liquid as well. And again, this one's going to be solely based on news, right? This is most likely going to be a company that's really reliant on catalysts, just like Rocket Lab. Until at some point it proves to be a good foundational company that has room for growth, right? And they're positioning themselves to be able to leverage themselves to really just literally skyrocket into space. So just like Rocket Lab is doing. So LLAP, Chris, I will kind of give you more of an insight once I do a bit more fundamental research on this one. But technically, it looks like trash. But again, we're in a state right now in the market where, well, essentially in the bull market, I've been saying this multiple times to you guys, to the public who's been watching my live streams and into my other videos, and mostly to my private members. trash stocks do extremely well during bull markets, right? And so if LLAP decides to do the exact same as any other trash stock, I can see this one just rapidly moving to the upside, exiting Earth's atmosphere and going into orbit, just like the name itself says, right? Terran Orbital Corporation. Almost sounds like a game company, right? A company that could be featured in the game. So, Chris, it's cheap. I mean, I can definitely take a stab at this one too, right? Maybe put maybe 1,000, right? Why not? Right? If this one decides to act just like every other, every other, I guess, space-orientated stock, like Rocket Lab, who knows? This one might actually rocket. But again, it's a penny stock, okay? I don't know exactly what's going on with the company fundamentals. I don't know what's going on with its debt. If it's going to show any type of, growth in the future. But whatever the case may be, all right, just know that on the technical side, this has room to go lower, all right? It's just like, I don't know, Chris, I don't know if you know this one. It's an EV stock, Mullen. But this one has been pretty bad, right? Well, this right here was from back here. I got a pretty nice move to the upside. Or actually, it was right here. No, wait. Where was this at? Oh, they had a stock split. No wonder. Yeah. So this one, no, they had a reverse stock split. One for 20. Oh, reverse stock split for 1 of 25. Damn, that sucks. Oof. Anyways, yeah. So this one was over here. I was wondering why the prices look different. So it was around like $1 something right here before the split, the reverse stock split. And I was able to play this nice run to the upside multiple times, on both times actually, equity-wise. But, just as a reminder, for stocks like that, like LLAP, this is a pretty good example of what these failing companies can do. So whenever I see a penny stock company like that, like Mullen here, have a reverse stock split, excuse me, I've been drinking a lot of liquids today. That tells me that the stock it basically failed, right? And the company can most likely be delisted from the stock exchange, which is NASDAQ for Mullen here, MULN or Mullen, and the company really needs to do something about this, and the only way that they can do is literally reverse stock split until its death, right? In order to try to at least make the share price stay above water, right, from hitting $0. So that's the really huge upside risk that you have for a name like LLAP2. And I'm not trying to be intentionally bearish if you have a bias to the bull side, Chris. But again, I'm just trying to assess the risks, right? I've always had people just hate on me because I provide two sides of the argument. I don't know how that could be a bad thing, but maybe because they're way too biased. But anyways, LAAP. I mean, why not? I can definitely take a stab at this one with you. Cheap name, penny stock. It's in a space where a lot of names like RKLB, right, has been rocketing straight up. So why not? Why not, right? Especially in a bull market where trash companies with trash stock prices tend to squeeze higher. All right. Chris, you said, appreciate the breakdown. I'll be looking forward to your opinion on the fundamental side. Awesome. Yeah, I'll send out a message on the private Discord. All right. Okay, guys. Wow, it's been an hour and 10 minutes since I started the live stream. Wow. Thank you guys so much for staying. Hey, 4 likes. Awesome. We didn't quite yet get to that 10 likes, but if you guys are watching the recording, make sure you guys hit that like button down below if you guys really enjoyed and learned something from tonight's live. And hopefully these 3 long-term investment stocks that I just gave you guys can become a consideration for you all for the longer term. All right. And again, I'm not forcing you guys to buy anything. I'm just giving you guys some potential recommendations that can potentially give you guys longer term rewards, plus on the side some dividend payouts along the way for the next 5 to 10 years. Okay, all right, that is it for tonight. Thank you guys so much for joining and for your time. I always appreciate you guys coming out tonight on Tuesdays and Thursdays every single week to join the live streams, and also, just really appreciate you guys for even chatting with me in the live chat room. Okay, so I'll see you guys this week again on Thursday at the same time, 6 p.m. Pacific Standard Time or 9 p.m. Eastern Standard Time. Have a great rest of your night and good luck tomorrow. Thank you so much again.